everyone, this is Joyjeet back with another video. In today's video, we are trying to create a stock portfolio using basic stock closing prices, which is easily available on Google Finance, and then employing statistical tools like mean, standard deviation, correlation, and normal distribution to finalize a portfolio. We will try to minimize the risk behind that portfolio using the Harry Markowitz model. Let's get started. Now, before we get into the details of the portfolio, let's understand some of the basic statistical concepts that we will need to know to create the portfolio. First up, we need to understand what is a normal distribution and the principles that we will be using from the normal distribution to create our portfolio. So, what is a normal distribution? A normal distribution is a continuous probability distribution and is typically represented as the famous bell-shaped curve. It attaches a probability value to any data point within a distribution. So, the farther away a data point is from the mean, it has a lower probability value. The way it is typically done is by using three central parameters. The parameters are measure of central tendency, which is given by the mean, the median, or the mode. For a normal distribution, they are the same. It also has a measure of dispersion or a measure of variability, which is given by variance and standard deviation. In our case, we will be using standard deviation. This would measure the risk behind a stock. And finally, the measure of shape, which is essentially given by skewness, which helps us to measure whether the probability values are equally dispersed on both sides of the mean. What we will try and do with the normal distribution is to calculate possible upsides and downsides to any stock. More on that once we start creating our portfolio. Now, moving on, a standard normal distribution is typically a normal distribution which has a mean which is at 0, a standard deviation of 1, and a skewness value of 0, signifying that the distribution is equally dispersed on both sides of the mean. Now here, if you look at the graph, you see the orange curve, which is the standard normal distribution, the bell-shaped curve, and on both sides of the standard normal distribution, you will see there are exactly 3 markings signifying 3 standard deviations from the mean. Each of these standard deviations on both sides of the mean gather a certain number of data points in that distribution. So, how to interpret this? Let's assume if a stock takes values from 1 to 100 on any given day or throughout its lifetime, then 67% of these values from 1 to 100 would be about 1 standard deviation away from the mean. The mean could be 50, the mean could be 60, and so on and so forth. Similarly, if we look at 2 standard deviations away from the mean, we would get a range within which the stock prices will be 95% of the times. Now, this helps us in measuring a relative upside and a relative downside to any stock. And it also attaches a probability of how often the stock will be breaching the upside or the downside. Now, if you take a much larger standard deviation, let's say if you go for 3 standard deviations, then you would be accurate 99.7% of the times vis-a-vis the stock value. This, however, assumes that the stock prices are normally distributed. And the way we will try to ascertain that in today's video is by looking at how many times the stock has breached 1 standard deviation value, 2 standard deviation value, and similarly 3 standard deviation value. Once we know that, that would help us in attaching a risk parameter or some credibility towards the risk parameter, which is standard deviation. Once we do that, it will help us in ascertaining how many times the stock can become so volatile that it breaches our set thresholds. Moving on, the other parameter that we need to know to understand how to create a portfolio is called correlation. And correlation is essentially a measure of relationships between two data sets. Here, the data sets that we will be using are stock prices, and we will see how correlated are the stock prices. Now, correlation typically is expressed as R, and it would take values from -1 going up to +1, and any value between -1 to 0 signifies that the stocks are negatively correlated, which means if one stock goes up, the other will come down. And likewise, if the correlation value is between 0 to 1, that signifies positive correlation, which means both stocks will move in the same direction. Now, this will be helpful when we try to ascertain the overall risk of the portfolio. Now, that covering the theory bit, let's just quickly dive into a practical example. Now, let's see how to get the base data for creating our portfolio. Remember, we would be employing all the statistical tools on closing prices of stocks, and hence we would need the closing prices of stocks over a given time frame. Here I'm using a Google spreadsheet, and within Google spreadsheets I'll use a special function called Google Finance. Let's say I want to look at the closing stock price of a stock called Trident in the Indian Stock Exchange Nifty on the 1st of January 2019. Why 1st of January 2019? Because I will try to evaluate the performance of the stock over 5 years and gradually break it down in smaller chunks, like say 2 years, 1 year, 6 months, 3 months and 1 month. And it will also capture the recency effect. So let's see how to get the stock prices. Now, what we need to do is we will need to type in equal to Google Finance. If you just type Google Finance comes up as the first option. Then it will ask you for a ticker. Remember, Trident could be any stock listed on any stock exchange, so you will have to specify which exchange. I am interested in Nifty. The short form for Nifty is NSE, National Stock Exchange for India. Then put a colon sign signifying that I would need specific value of a stock. Here I will add the ampersand sign signifying a concatenation between the stock exchange and the name of the stock, which will be Trident. So NSE colon followed by the stock name, which is Trident. The ampersand will help us in putting that together. Once we've done that, we will move to the next column, which is which parameter do we need. Google Finance does give you a lot of parameters. You can check that online, but we are interested in the price, the closing price to be specific. So I'll just type in price. I will then specify a start date, which here will be the 1st of Jan 2019. Remember, if you're pulling out date, you will have to use the American format for dates. You cannot use the Indian format. Next, I don't need an end date for the time being, so I will ignore it. And I will then finally move to the interval, which is daily. This also needs to be passed on in inverted commas. Now, once I've created the function, I press enter. It takes a little bit of time and populates the data. Now, the data is populated in a 2x2 matrix. Here you can see that it has date in the first column and closing price in the second column. And because I've specified one date, it gives me one row. Now, I don't need all of this information. I just need this particular value. So I will use an index function along with Google Finance to specially pick out the second row and the second column value, which will be index Google Finance followed by 2, 2. Now remember, the output is in a matrix form, and hence we are using 2, 2 to signify the last value in the matrix. Now, once I press enter, you will see everything disappears and we are only left with 6.75. Now you can further add dates and extend this function further to get data points across different days. I have already done that, so I will now pivot to an Excel sheet. The Excel sheet that you see in front of you has the data for 5 years of stock closing prices for about 58 odd stocks. All of these stocks are in the Nifty 500. So they're relatively well-known stocks. As we move down, you will see the data is of 5 years, and the reason I've pulled out data for 5 years is because I wanted to start with a longer time horizon and then gradually zoom in to say 1 year, 6 months, 3 months and 1 month data. If we now go down, you will see that the last date for which I've picked up closing prices is the 30th of October 2023. So that's roughly about 5 years. You can also see that all of these stocks have shown a significant appreciation in their prices, given that Trident started at 6.5 rupees or 6.75 rupees and has now kind of touched 35 rupees. Similarly, if you look at HFCL, it started at 21 rupees in 2019 and has now touched 65 rupees. So all the stocks have shown significant appreciation in their values. Now today I will create a portfolio of 2 stocks out of the 58, and you can use the same principles to create a much larger portfolio. The first thing that we need to do is calculate the average weekly returns. Now how am I going to calculate the average weekly returns? The simple way to do that would be to create a base date or an anchor date. Let's say, since we are starting from the 1st of January 2019, I'm taking that as the base date, and then compare the prices on 1st of January 2019 with the prices a week after. So that would mean 8th of January 2019. So if you see the formula here, it refers to B9 upon B2 minus 1. The minus 1 essentially is the return. So if I go up, you will see B9 refers to 8th of January closing price and B2 refers to 1st of January closing price. So likewise, you can create the returns, the weekly returns, basis anchor dates starting from 1st of January going all the way down to 23rd of October. Why 23rd of October? Remember, these are the base dates, and hence I will be comparing 23rd of October with 30th of October and then calculating the returns, the weekly returns. So this is essentially a simple way of calculating weekly returns. Now you will see that the returns have fluctuated over time, and it would be prudent for me to calculate the average return over the lifetime of 5 years. So if I go further down, you will see I have now calculated the average return for each of these stocks over their lifetime, and then started zooming in towards the recent data and calculated returns over 2 years, 1 year, 6 months, 3 months, and subsequently 1 month. So if you see Trident pretty much has the highest return over its lifetime, but as we get closer to the last month, we see that the returns have been diminishing to the point that the last month was negative. Similarly, if you look at HFCL has also seen a decrease in returns, especially in the last 1 month. However, if you look at this particular stock, which is FACT or FACT, FACT has actually seen an appreciation in the last 1 month, and it has given steady returns over its entire lifetime. So this probably would be a good stock to invest in. However, we will also need to look at the risks attached to this stock. So let's jump into the risk. The way we calculate risk is by calculating standard deviation across the returns. Let's see how to do that. Here I'm using a standard Excel function called standdev.p or standard deviation.p, and then I'm using an if NA to avoid any null values or any error values that I might get while calculating the returns. So if you just employ this across the entire price returns over the time frame of 5 years, you should be able to ascertain the risk behind that stock. So here the lifetime risk behind Trident has been 8%. What does that mean? That the prices are volatile enough to move 8% up or down over a weekly time frame. So that's a relatively large risk behind a stock, and understandably so, because remember, these are individual stocks and they are extremely volatile, and hence we will like to create a portfolio. If we further zoom in, and if you see the last 1 month, you will obviously see that the volatility has come down as we have zoomed in the last 1 month, and the reason for that is the growth and the appreciations have also come down, right? So volatility comes down as you zoom in, because the prices don't fluctuate too much over a 1 month period compared to a 5-year period. Now the stock that showed good returns, which was FACT, if you look at the volatility of FACT, the volatility is relatively high, and the volatility is about 12.7%, or the standard deviation is about 12.7% for the last 1 month. However, I think this is giving pretty good returns, so this will be one of the stocks in our portfolio. So let me color this. We can pick up a stock which is relatively less volatile and has given positive returns in the immediate short term, which is maybe MRPL. So this is another stock that has given positive returns even in the short term and has relatively low volatility. It's about 6% volatility, while FACT had about 12% volatility. So let's assume MRPL will be the second stock in our portfolio. Now, before we jump into the creation of the portfolio, I had said we will have to validate whether these two stocks follow standard normal distribution. For us to ascertain that, let's move down and let's see how the 1 sigma, the 2 sigma and the 3 sigma rules are distributed. Remember from the normal distribution discussion we had a little while back, within 1 standard deviation from the mean, we should ideally get about 67% of all the values in that distribution. Now, assuming that Trident or prices of the Trident stock are normally distributed, we should see a number close to 67% for 1 sigma, 95% for 2 sigma, and about 99.7% for 3 sigma. Here, since we have already identified the stocks of our preference, which is FACT and MRPL, we will directly look at their values. Now, here, if you see, the 1 sigma value for FACT is slightly higher than the standard rule, which is 67%. However, the 2 sigma value is about 95%, and the 3 sigma value is slightly lower than the 99% compared to a standard normal distribution. Similarly, if you go to the right and if you look at the values for MRPL also seems to have a similar distribution. So about 80% for 1 sigma, 95% for 2 sigma, and about 98% for 3 sigma. So while these are not exactly normally distributed, like I said a little earlier, this acts to our advantage because the probability distribution within 1 sigma is roughly about 80%. So that means about 80% of the times the value of the stock will be within the upper and the lower bound that we define. How do we now define the upper and the lower bound? Now for that we will go further down. The way we define the upside and the downside will be using again the principles of normal distribution, where we will start with the mean, add the standard deviation to define the upside. So as you can see here, for the lifetime upside, the way I've calculated that is by adding the mean to the standard deviation, and that gives us the lifetime upside, right? So this is typically the upside that you should see over a week's time in this particular stock. if you consider the entire lifetime of the stock. However, given that we are interested in recent data, we will be looking at the upside for last 1 month data. So the upside for fact, the stock that we are interested in, is coming to about 17.5%, and similarly the upside for MRPL comes at 8.1%. Now this is the upside or the maximum expected return with an accuracy of roughly about 80%. If we go further down, you will see that the downside, this is the downside for fact comes to about 8% over the 1 month period, and for MRPL will come to about 5%, right? So this is a relatively okay scenario. You will lose about 8% value on fact and about 5% value on MRPL. Right? If we now come down and try to create our portfolio, we would be needing the following, right? We would first need to define the stocks in our portfolio, then define their weekly returns, then define the risk, and similarly define the correlation coefficient and the portfolio mix, and then subsequently the portfolio returns, risk, and risk to return ratio. So let's get to do that. Like I said, the first stock in our portfolio will be fact, so I'm going to select fact here, and the second stock in our portfolio will be MRPL. So these are the two stocks that we are interested in, and if we select MRPL, you will see that we've got the two stocks in our portfolio. Now we will plug in their weekly returns, and the way we will do that is by going to the last 1 month weekly return. Next up, we will calculate the weekly return for MRPL. You can see that this is the weekly return for MRPL. Next up, we need to fill up the risks. Let's go to the risk column. This is the risk table. First up is FACT, and the second value will be MRPL. We have filled up their respective risks. Now we will have to calculate their correlation coefficient, because so far we haven't done that, and to do that we will use the correl function in Excel. So we will type CORREL, and remember, we are only interested in the correlation in the last 1 month. So if we go up, we will have to pull out the last 1 month correlation value, which will be, let's say, from the 24th of September going up to the 23rd of October, right? These are the base dates. Column H is the column for fact. You don't see the name fact at the top, but be rest assured we have picked up the column for fact. Now if we move to the right, we will do the exact same thing for MRPL, which is column X, and we will pick up values from 24th of September all the way up to 23rd of October. Again, these are base dates, right? Not the actual dates, the base dates on which the returns are getting calculated. So if you see the correlation coefficient is relatively large, which signifies that both stocks are moving in the positive direction. So they have a positive correlation. Now we will create a portfolio mix, a hypothetical mix. Let's assume 50% going towards fact and the remaining 50% going towards MRPL. Now this is something that we need to optimize. How do we optimize? We will optimize basis the risk to return or the return to risk ratio in this portfolio. Here we will be using the Harry Markowitz model, and we will take a slight detour to understand the Harry Markowitz model. Here is a quick recap of the Harry Markowitz portfolio model. We've created a portfolio of two stocks to marry along with our example, and the stocks are stock A and stock B. The respective returns are R1 and R2. The portfolio has a mix of M1 favoring stock A and M2 favoring stock B. Remember, the total portfolio will add up to 100%, so M1 plus M2 will be 100%. Now, if we come to the right and look at the portfolio returns, the portfolio returns is essentially a weighted average of the individual stock returns, and it is expressed as R1 multiplied with M1 plus R2 multiplied with M2. On the risk side of things, if you come to the bottom, you will see the risk attached with stock A is sigma 1 and the risk attached with stock B is sigma 2. The portfolio mix remains the same as M1 and M2, and we introduce a correlation coefficient between the two stocks, which is given as rho. Rho captures whether the relationship between the two stocks are positively correlated or negatively correlated. Now, when we come to the portfolio risk, which is given as sigma p, is equal to the square root of sigma 1 squared multiplied with m1 squared plus sigma 2 squared multiplied with m2 squared plus 2 into sigma 1 multiplied with sigma 2 multiplied further with sigma m1, m2 and rho. This gives the total weighted risk of the portfolio. That being said, let's go back to our example. Now that we've understood the math behind the Harry Markowitz portfolio model, let's calculate the return and the risk of our portfolio. Remember, the portfolio return is a weighted average, so I will use a sum product here and multiply the weekly returns of these individual stocks with the portfolio mix given in column F. So the standard return of this portfolio is 3.2%. Now, to calculate the risk, I will have to do a slightly more tedious calculation, starting with the square root and then taking the individual risk rates. Remember, I will have to square the risk rates along with the squaring of the portfolio mixes. This will be done for both stocks to accurately represent their risks in the portfolio. There will be a further coupling of these risks by introducing a factor which is 2 multiplied with the risk of individual stock multiplied further with the mixes of the portfolios or the mixes within the portfolio, and then finally multiplying the correlation coefficient. Once we do the calculation, we see that the portfolio risk comes out to be 9%. The return to risk ratio can likewise be calculated from these two values, and it comes to about 35%. Now the question is, what should be the ideal mix of the portfolio? And that's the final step in today's calculation. Now the way we will do that is by using data analysis scenarios in Excel. For that, you will have to go into the data tab in your Excel sheet, which may not be visible in my current screen. I have now made some changes to my screen, and hopefully the data tab should be visible now. Once you are in the data tab, please go to Solver, and inside Solver you will see a pop-up opening up like this. Remember, we want to maximize the return to risk ratio, and for that we will set the objective function as maximization of the return to risk ratio, which is this particular cell. The way we will try to maximize this is by changing the portfolio mix, and the way we will change the portfolio mix is by changing the portfolio share of fact. Remember, these two need to add up to 100, and the way these formulas are written, they will always add up to 100. Now these are the two changes that we need to make in terms of the solver. We need to put in two constraints, and the constraints are none of the portfolios should have a share which is less than 5%. So here I put in this particular value, which is the mix for fact, and it should be greater than 5%. So this is a constraint that I'm putting in. Similarly, I will put one more constraint, which should be the mix of MRPL, and that also needs to be greater than 5%. Now that we've put all the constraints and the necessary objective function, let's click on solve, and it will automatically solve the portfolio mix. And the portfolio mix here is highly favored towards fact, because remember, fact is giving not only a high return, but the volatility is not as high as returns. So from that perspective, the mix is 95 to 5%, and this is the return adjusted against the risk of the portfolio. As you can see now, the portfolio has a higher return to risk ratio. Now if you compare the two portfolios, the initial portfolio where we had a 50% mix towards fact and a 50% mix towards MRPL, we had a return rate of 3.2% and a risk rate of 9%. The risk adjusted for return, or the return adjusted for risk, was 35.1%. Now, given that we want to optimize this particular value, and that's what we use the solver for, we now see that the portfolio, the optimized portfolio, has a distribution of 95 in favor of fact and 5% going towards MRPL, which is now giving us a higher return, which is roughly about 4.6%, though the risk also has increased, but return adjusted for risk has also increased. So this tells us that you can invest in slightly more volatile stock as long as the risk is adjusted against the return. This is the crux of the Harry Markowitz portfolio model. You can add more stocks to it and you can make a comprehensive portfolio. We can discuss more about this in the comment section, and if you want me to make a bigger portfolio, do let me know in the comments. If you like this video, do share, and I'll see you in my next video. Thank you.